What is up, everyone? Welcome back to yet another video. My name is Darren from Chart Nexus, and today I'm going to be sharing with you a not so popular indicator, not well known indicator called the average true range, but also commonly known as the ATR. Now, a lot of traders, especially the experienced ones, will use this indicator in order to help them increase their winning rate and to help them protect their trades when they do enter the market. All right, so today I'm going to be sharing with you how to use this indicator. So the first off, let's start by understanding what exactly is an ATR. So the ATR basically is an indicator that measures the volatility in the market at the given moment. All right, so how it does that is it measures the average price movement of the stock given its historical price volatility. So basically, how much the stock has been increasing or decreasing in the past, don't know how many days. Now, the default setting is 14 days, which means that at that given moment, for example, if you are trading right now, at this given moment, what would be the estimated price movement given its past 14 trading days? All right, so that's basically what an ATR tells you. Basically, how much the price is expected to move at this given moment, given its past 14 days price movement. All right, so if you don't really understand what I'm talking about, let's look at an example of the ATR. Right, so here we have a chart right here, just an average chart. So first we have to go to the left side panel to find the average true range indicator. Now we just scroll up, pull up indicators, you'll see the average true range is at the top. All right, so you can see that the average true range is basically giving you a figure. It's basically telling you that at any given moment, so for example, if I take any given moment, so for example, right here, all right now, the market is telling you that the average price volatility at this given moment is 20 cents. Right, which means that it is expected that the price, given its past 14 days, will be moving either up or down by 20 cents. That is basically the idea behind the ATR and what the ATR is telling you. And as you can see, when the ATR is increasing, it is telling you that the price volatility is increasing, which means the market is whipsawing up and down in a bigger range. And it so happens that when the market is sideways, the average true range is decreasing, which means that the average price movement of the candle is getting smaller and smaller, which means it's not as volatile anymore. And that explains why it's in a sideways market and getting tighter and tighter. Look at its range, how it's getting smaller and smaller and smaller. But once it starts to trend upwards, you can see the ATR start to increase as well, which means that the volatility is back and the price is starting to move in a bigger range. All right, so that's basically the idea behind the average true range and what the figure tells you. All right, so let's go back to the next slide. So why should you use an ATR indicator? Now, usually we use an ATR indicator to prevent ourselves from getting stopped out easily. Now, I know probably a lot of you have traded the market before, and always you hear the idea of having to set a stop loss, right? You have to set a stop loss, in order to protect yourself in case market does move against you. But a lot of people don't understand, where do you set your stop loss? Do you set your stop loss by percentage? 5%, 10%, 2%? How? Some people set their stop loss by percentage, some people set their stop loss using a absolute value such as maybe 10 cents, 20 cents, or 5 cents, depending on their own personal preference. All right. So with all those different personal preferences, why not use an indicator to tell you relatively how you should set your stop loss levels in order to maximize your protection when you enter the market. Right? So that's just basically how most people use an indicator. How most people use this indicator for their trading. Now, another way that the ATR is very useful is that it can help you ride massive trends very safely. All right. So a lot of people do this by setting a trailing stop loss, which means that when the market is in a very strong trending move, you want to ride the movement as high as possible, but you don't want to step your stop loss at at where you started, at where you entered the trade. Because if you don't monitor your market and the market does move against you, it's going to corrode your profits all the way back down and you end up making a loss because you didn't monitor your markets. You didn't monitor your positions and end up you lose the trade when you could have made massive gains. So a lot of experienced traders, what they'll do is they'll use the indicator in order to help them increase their stop losses. As the price increase, their stop loss will increase. Their stop loss levels will increase. So they'll use the ATR indicator to tell them how low your stop loss has to be in order to not get stopped out easily, but at the same time protect yourself in case the market really does move against you. Right? So that's basically it. Now, basically, how traders or experienced traders use the ATR to set stop losses is first by identifying either the low of your entry candle, meaning if your entry candle is quite big, you can take the low of the candle that you entered at as a preference, or a strong support level. Now, after you have identified these points, usually people will set their stop loss levels 1.5 times the ATR at the current candle below the level that you have identified, which here we marked it as A. Right, so basically, I'll show you how to do that exactly in a minute. Now, remember what I said about riding massive trends using the ATR, trailing stop losses? Now, usually for trailing stop losses, we tend to set a tighter stop loss, which is 1 ATR, because if the trend is really moving so strongly, you don't really need a big stop loss in order to tell you that the market has already moved against you. All right, you can set a tighter stop loss that in the case that the market moves against you, you can get out earlier. All right, you don't have to set a bigger stop loss because the market is really trending very strongly. All right, so let's look at some examples so that I can show you how the ATR may help you in your stop loss setting. Okay, so here we have Emulus, and as you can see, I have already put up the average true range. Now, say for example, if you were in the market here, right? You're currently here and you saw that the market is going down, and then you realize that, okay, this is potentially a reversal signal. It's a sign of reversal because, volume is strong, candle close very bullish, and everything, right? So you decide to enter at the close because you want to confirm that it's going to close strongly. So you entered here at this price of 65 cents, right? So where are you going to set your stop loss? Well, we can see that the low of this candle is 59.5 cents, as you can see from the top. And we can go down and check what is the value of the average true range at that candle. And here we can see that it's actually 3.2 cents. Or we can just round it down to 3 cents, basically. So 1.5 times, remember guys, 1.5 times the ATR at the given moment. So it would be 4.5 cents. So your stop loss levels would be 4.5 cents below the low. So below the low of this candle is the low of the candle is 595. So if you deduct 4.5 cents, it's basically 55 cents. So it would be somewhere here. Yeah. Hold on. Yeah. It will be here, 55 cents. Now, as you can see, when the market does pull back, as it didn't continue its initial reversal, even though it was a sign of strength, the market pulled back up to this point and reversed strongly afterwards. So you can see how by setting your stop loss 1.5 times below the low of the candle, you manage to survive this massive pullback, right? Whereas if many traders, what will they do is that, they'll just set the stop loss right below the low. Maybe like 1 cent below the low of the candle or something like that. And what they'll see is that, the market hits their stop loss and instantly reverse. And then they'll just be looking at the chart and be like, what is going on? Why is the market so against me? What am I doing? So if to be safe, you set your stop losses 1.5 times the ATR at the current candle below the low of the candle that you enter. Now in this case, I use the candle's low instead of a support level. Where you can use a support level of what is this, 585, and it will be fine. You will still survive this trade. All right. So that's basically the general idea of why you should set your stop loss 1.5 times away from the low or the support of your entry, right? In order to safeguard your trade so that you don't get, market weakness by doing this kind of, very low volume pullbacks and hits your stop loss, kicks you out the trade. The next thing you know, it reverses, to the moon, right? So in order to prevent those kind of, shocking moments, set your stop losses 1.5 times away from the levels that I talked about, either the low of the candle or your support level. Now let's talk about trailing stop losses. All right. So trailing stop losses, I will have to find. Let's go to DNO. Yes, DNO had a very nice trend in the past few months ago. And let me just adjust the chart so you know what I'm talking about. Okay, so let's just basically pull out a moving average, because price is trending like this. It's very hard to identify support levels. So remember what we talked about in the last video? If you didn't, please check out the video about moving averages. But moving averages are basically very dynamic and very fluid support and resistance levels, right? It moves with the stock. So I would take this out. Let me just adjust. Personally, I like 20 EMA, but you can set any EMA is fine. Okay, so basically imagine that you were able to catch the trend anywhere. Gonna be here. Okay, let me just zoom in. So imagine you spotted this trend, you saw the price move higher and higher and higher, and you decide, okay, the price has pulled back to this area, 20 EMA. Yes, slow down, and it has reversed, with this big candle, big volume. So you think, okay, this is a sign of a reversal, So I'm going to enter at this candle. Let's remove this, and you enter at the close of this candle. This would be around 9:45. Right. So initially, because there's no support, you will set your stop loss again 1.5 times below your low, right? So by setting your stop loss 1.5 times below this low, and the low is 87 cents, and your ATR is around 5 cents, 1.5 times will be around 7.5 cents. So 7.5 cents would be 7.95. 7.95 will be around here. All right, and you can see, no, it doesn't hit your stop losses. But what happens if you hold your stock and you didn't take profit? So because you see like, oh, the stock is trending very strongly, and you believe the stock can trend higher. And when the stock does trend higher, and let's just say you're at this moment right here, in this area, you're not going to leave your stop loss here. Because what if the market just decides to pull back and reverse all the way back down and hits your stop loss here? And by the time you check your portfolio again, you notice, oh, you got stopped out. But you notice that you missed out so much profit potential, right? Because the market, yes, your stop loss is here, and your loss amount is contained by the stop loss, but you have missed out so much in terms of profits. So what experienced traders will do when they want to really save themselves and ride the trends, is that they will increase their stop loss levels. So for example, you entered here, right? And you saw that the market is here at this given moment. And you notice this candle is another sign of a reversal again. So what you can do is that you can adjust your stop loss level to be 1.5. Sorry, when you're trading your stop losses, you should already be doing one time, because you want to get it tighter, right? Because you want to maximize your profits. So one time your ATR below the low of the candle that you decide to take as reference to put your trading stop loss. So in this case, you want to take, I decided to take this candle as my trading stop loss reference. And this candle's low is 1.657, And the ATR at this candle is about 11 cents. So you want to set your stop loss 11 cents below 1.657, which will give you about 1.54, 1.547, 1.54 basically. Let's just put 1.55 lah. We round it up. So 1.55 here. Alright. So basically, if the market does move against you, you're protected. Right? You may not have taken your profits here, but at least you managed to still secure your profits here instead of letting it go back and hit your stop loss here. Right? So maybe you can do this many times. You can let's just say a few weeks later you decide to open your portfolio again and see that, oh wow, the stock has managed to go much higher. You look at the chart and you are maybe you're here. Right? Maybe right now you're at this candle. It's like, wow, this candle has been trending very high. So I want to increase my stop loss again. So you decide to put your stop loss. We take the low again. The low is 3.734. And the ATR at that given moment is about 30 cents. Right? So 30 cents below 3.73 is about 3.43. Which is, well, right, smack at this area. Yeah, so basically around here. 3.43. Let me just pull it down a bit more. Yeah, so 3.43. And you can keep continuously doing this until either you satisfy with your profits or you just let the market hit your stop loss. Right, so that's basically an example of how you can safeguard your trades and ride the trend as high as you want. Right, it can be done at any trend, so it's up to you. Right, so that's basically how you can use the ATR to help you ride the trend as high as possible, as high as the market will take you. Alright, so that basically concludes our video for today. It's a short video because the ATR is a very, very simple indicator. So that's all for today. I hope you guys understand the ATR, and if you have any more questions, do leave it down in the comments below, and subscribe to the channel for more. And if you like the video, please do give us a thumbs up. But right before I let you go, I want to give you guys a test just to see if you understand. So we're going to go back to the chart that I talked about and just remove all this mess. And I want you guys to tell me, given that this candle and the low is 4.113 and the ATR is 24 cents at this given moment, where should your stop loss be? Where should your trailing stop loss be? Alright, so let me know in the comments down below, and and we'll see if you're right. So yeah, so that's basically the end of the video. Alright, so please do give our video a thumbs up and subscribe to the channel for more. Alright, so my name is Darren, again from Chat Nexus, and I'll see you soon.